I think we can get started. So, as I said, welcome. Thank you for joining us this evening. This is our annual strategic asset allocation event. Basically, this is our insight into our investment strategy, a lot of thinking that our portfolio managers do, which will be introduced by our Chief Investment Officer, Richard Flax. However, beforehand, there'll be a note from our Chief Investment Officer, CEO, Giovanni Daprà, who will kind of give a few updates of Moneyfarm as a company. And then later on, I will run through a few changes that we are looking at from a company standpoint, just for people to see where we're at. And we'll have a Q&A as well as we go along to answer people's questions. I'm sure a few people have got some questions about the situation in Ukraine. Don't worry, this is covered in the slides, but obviously please feel free to ask questions and we will answer them as well. But yeah, so without further ado, I'll hand over to Giovanni.
Hello everyone, and thanks Chris for the introduction. Let's wait another couple of minutes for seconds for the people who join. We're still a lot of people joining. Okay, let's start. So thanks for everybody. Thanks for participating. As Chris said, we have been working quite hard to try to bring you what is our best thinking on the strategic asset allocation, which is a process that we run every year, where we are effectively rethinking our positioning of the portfolio, and particularly the expected return for the asset classes. It's a process that it's very important to us because it also allows us to stop, pause, and reflect. And particularly now, given the current market situation, which is definitely different from what it was last year, it gave an opportunity to really spend time and go and basically get a deeper understanding of what was going on and how could this turn of event impacting our portfolio performances. I will start to say that 2021 has been an incredible year. We've delivered a lot of value to our customer, and financial market has been extremely supportive. In that time period, we also did a very big fundraising led by M&G, and we were very happy to have M&G as partner, as shareholders. They're one of the best known brand in the UK, and they have a very deep knowledge of the UK landscape, managing more than 350 billion of assets, and particularly they're one of the few asset management firm that has a keen interest on the end customer, and that's why we were very aligned on the need for the industry and for ourselves to really continue to deliver more and more value to yourself as end customer rather than product manufacturer. So we were really happy about M&G, and is gonna continue to expand our ambition in the UK. On top of that, I want to welcome all the Wealthsimple customers. As you probably, some of you are aware, we effectively transferred the Wealthsimple customer book to Moneyfarm, which was a very big important step for us, and we do hope that we're gonna excel at the service and proposition for all of you that join from Wealthsimple. We really put our best people into that, and Chris and the team and the engineering team has worked extensively to try to minimize the time out of the market and all the, let's say, unnecessary pain of a customer migration. And we were quite happy to how it turned out, and we're still working very, very thoroughly to make sure that all of you came from Wealthsimple are confident and get to know the team, get to know Moneyfarm as a company, get to understand our capabilities to really continue to trust us with your money. I think that the document that we're going to share is very specific about what we define as the 7 key challenges going forward for the market. it is fair to say that the market environment is very, very different from what it was at the start of 2021. And to a certain degree, we feel this as a positive because we know that in this market, particularly for the core of our customer base that needs to continue to accumulate and invest for the long term, there's going to be opportunities to continue to invest and effectively getting more exposure out of cash at prices that are probably less difficult to digest versus the one before. So overall, we always look at this moment where we have to really critically manage the portfolio. We have to really spend extra amount of time and resources to understand what's going on. But ultimately, as with the benefit of the opportunity that for a customer that still needs to accumulate the majority of his or her wealth going forward, those are opportunity to continue to gain exposure to the market at levels that were better or can generate better expected return over time. So with this, I think that I will leave the word back to Chris. Again, I'm really happy to be here. I think that for us, 2021 was a very positive year. So we have a lot of innovation and a lot of new things coming our way. And we do really want to help you in this, particularly in this market period, to maximize your long-term outcome, and do come back to us with feedback, comments, concern, because we are really here and we do always the best to try to put the Chris team of investment advisor or Richard team of invest analyst and asset allocation team at the best use of what we do best, which is effectively allow you to have a very positive outcome over the long term. So over to you, Chris.
Thank you very much, Giovanni. I saw a question about whether we'll circulate the slides afterwards. Not only will we do that, I mentioned it at the start, you may have missed it, we will be cycling the recording of this event. And actually there is a document which we will send, which is a very much in-depth look at what Richard is about to talk us through right now. But yeah, Richard, the floor is yours.
Thank you, Chris. Good evening, everyone. Thank you very much for joining us. I'm going to talk about three things this evening. Firstly, just to look back at 2021. It seems already like a long time ago, but there are, I think, a few things worth highlighting there. Second, as Chris and Giovanni mentioned, talk about our annual strategic asset allocation process, which is really the opportunity to take a step back, look out over a longer time period, and really think about key macro variables and starting valuations as the most significant drivers of long-term expected returns. And finally, we'll say a few words about 2022. It's already been a very interesting year and looks set to continue that way. So first, a quick look back at 2021. It was a year of very strong macroeconomic growth after obviously a very challenging 2020. And what we see here is that actually in the United States, you've already sort of the trajectory is already back to where it was even prior to COVID. The rest of the world hasn't quite got there, but it was a year of very strong macro growth, and that had some positives, but also some challenges along with it. One of the challenges has really been on the inflation side. We've seen inflation pick up very strongly. It's all over the newspapers, and this is a chart showing UK inflation, and we've plotted it here against the price of oil to show that to some extent there is a supply component to this. The supply of a lot of goods and commodities has been constrained over the COVID period, and as demand has recovered, you've seen a little bit of an imbalance between them. Nonetheless, inflation is something that's very much in the forefront of our minds as investors, and obviously very much in the minds of policymakers, particularly in the central banks. In terms of returns, 2021, as Giovanni mentioned, was a very strong year. If you look at the far right-hand side of this slide, what you see is that global equities returned nearly 20%. Global bonds, however, were negative. The other point I guess I would highlight here is that that it wasn't universally positive for global equities. Emerging market equities did suffer to some extent due to policy changes in China. And what's not perhaps captured here, but is maybe worth highlighting, is that some of the the individual stocks, individual companies that had really benefited from the uncertainty and from the changes in behavior during 2020 came back down to earth a little. Some of the very high expectations that were built into some of those businesses have deflated to some extent. So you obviously saw a very strong year in terms of overall developed market equities, but there were along the way pockets of difficulties, pockets of challenges. But if you look back over the other part of this chart that's interesting is that you look back over longer time horizons. It's particularly relevant during a period of volatility, and you do see over time some pretty consistent and healthy long-term returns, and it's worth keeping that in mind.
Just one thing to quickly jump in here, actually, Richard. In the grand scheme of, well, the background where we are talking now, and a couple of questions been about the performance so far in 2022. I think this is a fantastic indication of where you will hear us always say, well, investing is for the longer term. It's all about diversification. I think this chart sums it up perfectly. For example, you look at some of the years, 2020, 2018, we've seen some obviously some of the asset classes have struggled, some of the different sectors have struggled, but on the whole, you see that if you can kind of invest for the longer period of time, some of the best years tend to come next to some of the worst years. And that's true on a monthly basis, on a daily basis. And really, in terms of high volatility, you will always hear people such as myself or across anybody in the industry say, keep calm, stay invested. This chart perfectly proves why that should be the case, because whilst it may seem while you're in the midst of something it's very negative and markets are going down, if you take it on a much broader year, across multiple years, you can really see that things do recover and things come back. And again, the differentials between the different performances really show the effect that diversification can have. So yeah, I think this is a great slide, Richard. But sorry, back to you.
Thank you, Chris. So let's turn to the strategic asset allocation process. As I mentioned before, it's really a chance for us as an investment team to take a step back and think about key macro variables rather than getting lost in some of the daily noise that you see in financial markets. So in this process, it's designed to be quite mechanical. It's designed to take out as much of the sort of potential behavioral biases as it can, and really focus on starting valuations and long-term macroeconomic variables. In some ways, it's maybe easier to forecast these things over a 10-year period than it is over a 1-year period where noise and idiosyncratic risk can have more of an impact. So the purpose of the SAA is to as I say, to allow us to take a step back, to provide a sort of fairly mechanical set of outputs, and for us to then debate as an investment team, to debate those outcomes as we think about not just the coming decade, but also the coming year. So when you look at the long-term expected returns that this process generates, a few things to comment on. First, there are challenges in the fixed income side. Starting yields are very low, as you know, and the strategic process makes an assumption that monetary policy will normalize, and so the result of that is that you have fairly low expected returns for developed market, particularly for government bonds over the forecast period. Those returns improve a little bit when you get to high yield or emerging market debt, but it's really on the equity side that you continue to see a slightly better set of returns. But as we'll come into it in more details, that those returns in global equities are not evenly distributed. There's a significant in the strategic process. There's a significant dispersion between the expected return for US equities and for non-US equities. And to a large extent, that's a function of starting valuations, where particularly after the recent moves, non-US equities look broadly in line with their recent history. US equities continue to trade at a slightly higher valuation than their long-term averages. Now we can go into that in a little bit more detail and later on and understand why that might be the case. But for the purposes of a very long-term time horizon, it's important to think in terms primarily of those macro variables rather than perhaps things like corporate profitability. So what we see here is some challenges on the developed market government bond side, some better valuations, at least at the headline level in terms of global equities, but really an environment that reflected some of the strong performance that we've seen over the last couple of years. Just to return to fixed income, I won't spend too much time on this, but it delves into it in a little bit more detail, showing the extent to which government bonds may struggle given starting yields and also the assumption of normalizing rates over the forecast period. So rates will go up and that will most likely hamper returns. On the equity side, just to illustrate the point here, what you see is that the expected return for US equities is lower than it is for most other markets. The UK, as it has done for a couple of years, looks relatively cheap compared to some of its peers. Emerging market equities, obviously after a challenging year last year, also look a little bit better. And these are the things that we think about from a long-term perspective. They don't necessarily translate directly into portfolio positioning over the shorter time period, over a tactical time period, but they are an important indicator for us as we think about how financial markets will develop over the tactical time horizon. And they continue to influence our thinking about the drivers of returns. What are the things that we should focus on? So when you think about the strategic portfolios, these are obviously risk adjusted. So we think in terms of what sort of return can we get for a given level of risk. The high risk portfolios, as you might imagine, continue to be relatively heavily exposed to global equities. When you dig into the granularity, they tend to prefer, as I suggested, non-US equities, emerging market equities and non-US equities relative to US equities. And then as you go down in terms of risk level, you continue to see an increase in fixed income, perhaps less on the government bond side and more on the credit side, looking to find ways of generating returns for these portfolios by taking on credit risk, where we think the returns are a bit better.
Just to quickly jump in with a couple of questions, I think it's a good point to bring some of the questions from the Q&A into play here. On the points that you put about the different asset classes, where, how have you put these into play already? Have you factored these into any sort of decision making already this year?
Sure. So you'll have seen that we did make some changes to the portfolios over the past couple of weeks. And we did sell some of our US equity exposure. We still have a good amount of US equity exposure, but we did sell some of that, and we have bought some UK equity exposure. I think it's worth kind of keeping in mind that we typically don't have a very significant home country bias in terms of how we build these portfolios, whereas perhaps some managers will be more heavily exposed to the UK than perhaps might be the case within a global equity universe. We typically follow that universe a bit more closely, but nonetheless, we continue to think, or we do think that UK equities represent better value than we've seen for a while, and we've reflected that in some of the changes that we've made. In terms of other things that we've done, we did add to some broad commodity exposure. So we've sort of followed the SAA on that. We added a little bit to emerging market equities, and we have continued with weights that are in emerging market debt that are perhaps not as high as the strategic asset allocation would argue for, but we did add a little bit to the emerging market debt space, really trying to find ways of generating some return and some income. In terms of a duration exposure, we continue to not particularly like longer dated government bonds. We do have some government bonds that we use really to manage the risk of these portfolios, but we have had a bias towards shorter dated government bonds. And that's been, there have been times when that's been challenging. Obviously, longer dated government bonds have seen their yields rise, and you've seen some volatility in terms of fixed income returns already in 2022, as you did in 2021. So I guess what I would sort of conclude with is that we have seen, the debates around the SAA, the strategic process, reflect themselves in some of the changes that we've made to the portfolios already this year.
And that leads into another question that's come up, and probably leads us into the next section is, how much of the decision making is based on the SAA, and how much do you feel that you put more of a tactical tilt? How does that decision making process work?
So I would say that the SAA does act as a sort of guardrail for us. It certainly informs our thinking, but it's not something that we blindly follow, because we acknowledge for various reasons that it is a very long-term, focused set of models, and they are models, and we think that applying judgment, applying debate, and insight is can be valuable, but they do provide guardrails, and they do provide a signal that we think is very helpful. If you want an example, perhaps, of where we haven't listened to it, the strategic asset allocation models have generally not liked the US, because they've thought in terms of starting valuations and in terms of macroeconomic growth, and what they don't capture perhaps is some of the shorter term improvements in profitability in the US that we've seen. And US corporate profitability has been stronger than has been in the case in most other parts of the world, and that has helped, I think, to drive some of the outperformance of US equities in recent years, and we've been mindful of that, I would say.
Fantastic, thank you. And one last one before I let you go on, because I see quite a few about the Ukraine, and don't want to leave people waiting for too long, but I saw a very good question about ESG. I will touch on this later on as well in terms of the portfolio section, but there has been a differential in the performance between the ESG and the classic portfolios. What would you say about that? Yes,
so look, I mean, the short answer, I would say, is that ESG, the ESG portfolios perhaps have a bit more of a growth bias. When you think about the types of companies that are excluded from ESG instruments, it is things like commodity companies, and obviously you've seen commodities perform relatively well, and some of that is replaced with some, for instance, some technology companies. And so the consequence of that is that these portfolios have a little bit more of a growth bias that obviously helped in 2021, and has I think caused them to suffer a little bit relative to the standard portfolios in 2022. I think it's important to reiterate something that we said at the time that we launched the ESG portfolios, where over time, we continue to think that you won't suffer in terms of performance relative to standard if you have that ESG exposure, but it's certainly you certainly wouldn't be looking for these portfolios to consistently do better, or to outperform. We think that over time the standard and the ESG can perform actually in line, but over any given short time period, one will potentially do better than the others. But when you think about the explanation for this, we do think it's somehow related to the growth exposure, and what you've seen over the last few months is that value stocks, having underperformed for many years, have had a little bit of a renaissance over the last few months. That may continue. It may not, but we think that's been one of the drivers behind the relative underperformance of ESG compared to the standard equity portfolios. Fantastic. Thank you very much. Well, I'll let you carry on with the slides. I see the Ukraine ones are coming thick and fast now. So sure. So let's say something about Ukraine. First and foremost, a very fluid situation, changing minute by minute, which always makes you hesitate to make too many definitive pronouncements on it. The base case that we have as of today is that we, that this will likely not have a long-term impact on global financial markets. It seems reasonable to think that there will be some continued shorter-term volatility, particularly for assets that are more directly related to Russia and Ukraine. But what we've seen in the past is that these sorts of geopolitical tensions have not had a material long-term impact on global financial markets. Now that's our base case today, and that's reflected in the things that we did and I would say didn't do when we last rebalanced these portfolios, and it's inevitably something that we will monitor very closely. So when you think about what does that mean? We don't have a very significant direct exposure to Russian equities or to Russian fixed income, for instance. We do have some commodity exposure, which I guess will potentially be a beneficiary. But our basic thought here, if we're right in our base case, is that there will be the volatility will be with us for a while. It will be more pronounced in those asset classes most directly affected. But it's something that we think will and I would say we hope obviously on a personal level will fade over time. But again, something that we clearly need to be watchful of and be ready to act if we see something that causes a change in view. When we think about other potential sources of volatility, as I mentioned here, we do think that the potential for disruption on the energy side, and I showed you the chart earlier of UK inflation and the price of oil. There is some potential there for that to have an inflationary impact or further inflationary impact. The impact on the Eurozone and Eurozone growth is something that we'll continue to monitor, and there is the potential there that it may, if growth expectations were to be downgraded, that would be something that would factor into the thinking perhaps of the ECB. So when we think about it, today and around the portfolio construction, we come back to first principles to diversification in terms of both of asset class, of bonds and equities, but also of regions, of geographies. And we continue to look and to stress test the portfolios to try and understand how they could behave. I think we're also mindful of the fact, given the weakness in equity markets over the course of the year, that the risk here is somehow, from a financial markets perspective, the risk here is two-sided. That there is clearly the downside risk of a further escalation, but equally that if you saw some sort of a normalization, that potentially the relative weakness we've seen in some parts of the market could represent an opportunity for us. And so we're very mindful that there can be risk and reward is still very much in play here, we think. So that's our general thinking on Ukraine as of today. It does continue to be a very fluid situation, but we continue, as I say, to think that it will most likely be contained. Chris, were there any other questions on that, or did that
I think that
answer the gist of the Ukraine questions?
No, I think it did, but please keep the questions coming because we will have a Q&A question at the end, section at the end. So if there is anything that wasn't answered on that particular section, please ask away, and we'll come back to it later on.
Okay, so let's take a step back briefly, and then for 2022, the indications on COVID are constructive. At least in the UK, restrictions are being lifted. we'll see whether prematurely or otherwise. But for now, at least, it's something that is fading from a financial markets perspective, I would say, if not from a human perspective, ever so slightly. But we obviously need to be cognizant of the fact that you could still see new variants emerge, and there will still be some much needed flexibility in terms of from healthcare professionals, from policymakers, and to the extent that it becomes relevant from a financial markets perspective. But one of the narratives that has clearly dominated financial markets over the last 2 years is beginning to fade, at least just a little bit. That, to a large extent, has been replaced by inflation, and inflation has risen very sharply, has proven to be less transient than certainly than most central bankers were hoping, and it's something that has clearly begun to factor into thinking around monetary policy. I'll touch on that in a second. The right-hand slide again is showing the cost of shipping containers from, broadly speaking, from Asia to Europe and the US. We saw that rise relatively sharply in 2021, and we haven't yet seen any material declines. And what I guess it's a reminder that demand has recovered quite nicely, but supply continues to be somewhat constrained. And if that continues to be the case, it does take time for new supply to come on stream. It's not so straightforward, obviously, to build new container ships very quickly. We would expect to see a supply response over time. We are seeing signs that demand is normalizing a bit, but it's not simply a challenge that central bankers can manage through monetary policy. Nonetheless, we have seen expectations for monetary tightening, for higher interest rates, steadily drift higher, particularly, I would say, for the Fed and for the Bank of England, and more recently for the European Central Bank as well. And so one of the debates that we have as an asset allocation team is we can see what is priced into fixed income markets in terms of the number of hikes, and one of the questions for us is, to what extent do we think that that's been fully digested in equity markets? Our starting thinking is that a good amount has already been digested, that markets are sufficiently joined up to reflect some of those changes. But one of the challenges that we think we'll face is to think about what the implication is for growth. And the point there is that valuations, as I'll come to in a second, look in line with long-term averages, certainly have come down from where we were in 2020, as you would expect. But we've also seen corporate profitability continue to rise. And so the question is, as we see central banks tighten, will we see corporate profitability come under some pressure? And it's a delicate balancing act for policymakers. But so far, what we've seen is, particularly during the pandemic as well, that corporate profitability has been pretty resilient. And so we think that central bankers will be cautious about driving economies of choking off recoveries. They've been relatively cautious in terms of hiking rates, and we think that they'll be wary of moving too quickly. But again, when we think about the concerns that we have, that's clearly one of them. So just
a quick one.
Sorry,
just to interject there. Firstly, I mean, obviously it has quite a few, the expectations have been raised, and that will have a negative effect on pricing. But given the start to 2022 we've had Russia and Ukraine aside, how much do you reckon is that already priced in, would you say?
Look, it's difficult to put a firm number on it. What we do think from a longer term perspective, for instance, if you take it back to the strategic asset allocation point, we can say that the long term expected returns have probably drifted higher over the last couple of months, given that they're less focused perhaps on the on the short-term volatility of corporate profitability. And the chart that you see here sort of illustrates the point. These are the forward price earnings ratios for the UK, the US, and emerging markets and kind of developed equities. And what you see, I would say, is, you know, at the time of the pandemic in 2020, obviously you saw markets fall very sharply. You then saw this very big recovery ahead really of the earnings. What we saw in the course of 2021 was a normalization of these valuations as that corporate profitability came through, and came through even a bit faster than people might have expected. And that's really driven valuations down towards their longer term averages. And that's perhaps what you might have expected to see, but still reassuring to see it. But you do clearly see here the gap between US equities and non-US equities in terms of where those valuations are. And the chart here tries to, the right-hand chart in particular, tries to explain why. What this does is goes back to 2017 and plots corporate earnings by, you know, for the emerging UK, US, and developed market equities, excluding the US. And what you clearly see is that US corporate earnings have far outstripped everybody else. And that sort of prompted the re-rating of the relative valuation premium that the US has historically traded at. And we think that's justified. If you look at profitability measures like return on equity, net margins, you see that US corporate profitability is higher than it is elsewhere in the world. And, you know, even though generally speaking, all parts of global equities have seen their corporate margins improve over the last couple of years. But at this point in time, we do see a relatively, perhaps a better opportunity outside of the US than in the US. So when we think about, but when we think about the underlying environment, you know, as I say, one of the key drivers has to be that you know the global economy does continue to recover. As I say, you know, what we've seen is that listed companies generally have done a very good job of managing their profitability, of generating corporate profits. And absent a recession, you know, we think that's likely to continue. If you did see a recession, you would see a hit, at least in the short term, to that profitability, or at least you have done historically, with perhaps the notable exception of 2020. But in general, absent a recession, absent of a financial crisis of some sort, which is not something that we would expect to see, we do think that corporate earnings can remain relatively robust. The other thing to draw from this chart is that earnings revisions, so the expectations for corporate earnings, have continued to drift higher. Perhaps not quite as sharply as they did in the middle parts of 2020 or early 2021, but we continue to see in aggregate earnings for global equities continue to drift higher, and that's a helpful support, we think, for global equities. So I would just make one final chart. This was something that we did that we thought was interesting, which was looking at developed market equities since 1970 and thinking about the probability of loss over a given time period. And it was really designed to sort of illustrate the point that Chris made at the start, which is that historically, and it is historically, you know, the probability of losing money in developed market equities fell pretty sharply the longer you held them. And if you held them in this simulation for more than about 7 years, the probability was really below 5%, which wasn't to say that you couldn't lose money, just that the likelihood that you would do over any kind of time horizon or longer term time horizon was fairly low. And as we think about the current market volatility, it's an important, we think it's an important message to remind ourselves of. So with that, sorry, Chris.
I was just going to say on this point, it's quite for those people who have been through our suitability and have wondered why we always say, you know, the longer you invest, the more kind of risk we'll put into your portfolio. This is exactly the chart that shows it. sometimes people come to us and they say, well, I'm investing for a short term, therefore I want a higher risk and a higher return. This is ultimately the chart that shows why that is not the mentality that at least we have, or is generally the practice. And I think that's quite an important one for people to bear in mind, particularly when making their decisions about their goals, how they're looking to invest, and what the right asset allocation is for them in that scenario.
So I guess what I would just to finish up on 2022. Clearly, we're in a period of market volatility. You could imagine that that's going to continue for a little while longer. But we do think that the underlying environment is relatively robust at this point. Clearly, we need to think about the macro variables, things like the inflation outlook and the growth outlook in particular, over the longer term, to validate that view. But I would say that we continue to think about the risks and the opportunities in the portfolios as relatively balanced. Particularly as we've seen some of the volatility over the last couple of months. So with that, let me turn it to Chris, and we can leave any other questions, I guess, for the end.
Fantastic, thank you, Richard. Yeah, just to Richard's point, please keep the questions coming. We will have a Q&A section at the end, so please keep them coming. We do really want to address them as soon as we can. Obviously our team are working very hard behind the scenes to answer these, which is great, but yeah, please keep them coming. Brilliant. Just moving slightly away from the investment side of things, we also like to just talk about what's happening with Moneyfarm and what's happening to what you can see on the platform and things like that throughout 2020 as well, just to give a kind of a holistic view of Moneyfarm in 2020. So if you just go to the next slide, please, Richard. It's important for us to just before we go into it, this is the kind of the three core values that we have, which frame all the decisions that we make. And every decision that we make is really in trying to maximize these 3 points, really. Hopefully they're fairly self-explanatory, but obviously in a world of complicated, jargon, lots of noise, lots of charts, this sort of thing, we think that simplicity can be achieved and is, really kind of soothing for people, to be able to kind of invest with confidence and, knowing what's going on and things being very clear, having someone on the human side to talk them through it. So, as you can see on the chat today, but, please, like I said, book an appointment with a consultant if you haven't already. I think people generally really enjoy that one-to-one relationship, and efficient, no extra costs, no needless expense, really trying to make sure that what we deliver to our clients is, as straightforward and as cost efficient as possible. Just moving on to the next one. So just broadly speaking, these are the three kind of bubbles that we've looked at in this scope. Actually, I believe they can probably be defined into two. One is very much on the developing a more varied, a more, shall we say, giving more opportunity for different types of investment, for different products for people to invest in, and making kind of beyond our set range now, really expanding this from our side. But on the other side, it's about the service and making sure the service on the other side of that is really kind of robust. It maintains its kind of, high level of service. And as we grow, we grow our resources. We make sure that the functionality, the usability, and everything of the platform continues to improve. So that not only the products that you have, but it's also the experience that you have as well. And I think that's really important for us. Again, particularly as we scale, we want to maintain this quality that we feel we already have. But yeah, please, just moving on, Richard, to the next slide. So we touched on this one slightly earlier. I mean, this is something that we released not so long ago. It's not necessarily new in itself, but something we'll continue to develop. But it really kind of was our starting point of developing products that people can invest in, again, outside of the pension, the ISA, etc. Giving some people a different opportunity or different set of portfolios to invest in. As Richard touched on earlier, over a longer period of time, we don't expect them to perform any better or worse, but they go through the same process that Richard's outlined for the investment strategy, but obviously with a different screening process on top. So taking out high carbon emitters, taking out, companies with high inequality in their work staff, this sort of thing, really trying to build, a set of portfolios which are kind of more socially responsible whilst having the same financial characteristics as the existing ones that we have. So far, it's been quite a success. I think, obviously, as we know, the world's moving in a certain direction, which is great, fantastic. You saw it, obviously, with COP last year. And, we've seen it ourselves, in the first 6 months of the product, 106 million has been invested into it. And 40% of our new clients in January actually chose an ESG portfolio to start with. So really, really happy with that. And that's, kind of a really good, strong kind of base. And the starting kind of string in the bow for us to release a new set of products. Moving on to the next one, this is something that you might have seen recently. We actually released this week, or the week just gone, is our Junior ISA product, which we're really, really excited about. For those that aren't aware, a Junior ISA is a product that you can invest in on, the guardian can invest, or a legal guardian or parent can invest in on behalf of their child, up to £9,000 per tax year. And this then will turn into an ISA pot for when the child is 18 for them to manage themselves. It's a really, really good way of kind of educating people or children in the ways of the market, the ways of investing, which is, perhaps a skill which is not readily taught at schools or anything like that. And can really teach the correct behavior from an early age so that people can really maximize the most of their kind of earnings later in life and really, really kind of help reach their goals when they're an adult. One thing I always find is really, really important with a JISA, and obviously it's never too late to start, but the beauty of a JISA is if you can start really, really early, you can really make a lot out of a little, if that makes sense. What I've put on the chart below is an example where someone's put £100 a month into a junior ISA for 18 years, so starting from the first month. Again, obviously the effect will be there with different amounts, different timeframes, but as you can see from the divergence of the two lines, the longer that you can go, the more that the compounding effect of growth can really have on returns. Now, don't get me wrong, this is an assumed return of 5%. Obviously, as we've discussed and as you've seen, earlier in the thing, money can go up and down when invested, and your capital is at risk. But just to really show an example of the opportunity of starting early, by putting away a small amount each month or putting away a smaller amount each month, you can end up with quite a big part at the end. Obviously, you put away 21,000 or 21,700, but that actually ends up being 35,000 with the growth that you go through, and that's really quite something. So I think that's an important message, and really, and that's just starting with the JISA until they're 18. If they can continue on that path going forwards, and they continue that through life, that compounding effect and time in the market can really, really grow from there. I think that's very powerful. Last one on the product side, moving on. I mean, there's a few other details, a few other products that we are looking into. For example, 100% equity portfolios, not necessarily so exciting, but things that people have asked for, demand is there, we're looking to introduce. But I thought I'd pick out one particular one, which I think is very, very exciting. The timelines on this one are not particularly clear yet. We're kind of in the process of building it and scoping it, but we're looking to release this year. Essentially, what this is thematic portfolios, sometimes known as core and satellite portfolios. So what is this? Basically what we're looking to introduce is essentially, you will still have your existing portfolios, or those who are Moneyfarm clients will have their existing portfolios, or new clients come in will have the ability to set something up, but they have, people have the ability to select a couple of themes that they would like to be more exposed to. Now, obviously, these are kind of still a work in progress, but things like clean energy, water, biotech, little themes where people can kind of really have an interest in, can actually have a little bit of should we say, a higher weighting in their portfolio. They can decide, look, I want a bit more of my portfolio weighted towards these, and we will oblige. This will still be managed by Richard and his team, and obviously everything will be done on behalf of clients. But clients can really put a little bit more of their personality into the portfolios, have a little bit more of a say, have a little bit more, say, excitement in their portfolio that they want to visit. And this will really give them the opportunity to do that. It will still be matched to people's risk levels, in the lower risk level side of things. You cannot have a few themes at the top, you'll probably have a lot, but everything will be matched to your goals and it will be managed for you. But again, you can kind of have a little bit more input. And if you really wanted to kind of have these themes in there, we're looking to introduce this possibility. So yeah, we're excited for that. But yeah, just going on to the last slide on this, like I said, I think what's really important for us is whilst it's really exciting to say we're releasing this product, we're growing in this way, you know, this is really, really exciting. I think one thing that we really want to make sure is, as we grow, we really want to make sure that the service that we provide maintains a level of quality. You know, we don't get too stretched, we don't try and do too much and forget about the, you know, the existing clients and the things that really, really matter to them on a day-to-day basis. As we said, you know, as the client base grows, we pride ourselves on being a hybrid model with a human team there. Quick reaction times, you know, being there if people need us, you know, not waiting in a queue if they want to get in touch with us. So as the client base grows and has grown a lot, we need to make sure that this team grows as well. And as you can see on the screen here, we really we've invested a lot in the team so far, and we will continue to do so throughout the year, just to make sure that, you know, that kind of relationship that we build and that we cherish with our clients maintains the same quality. On top of that, we're looking, you know, we have a variety of different mediums to get in touch, obviously in-app, the phone, the chat, the email. We'll look to obviously as well introduce a video call this year. We've done a few trials, it's gone, you know, we're happy with it. It helps us to really build a better relationship with the clients. And yeah, we're hoping to launch that in the coming months as well, just to really enhance that experience. On top of that, on the technical side of things, it's really important for us to make sure that obviously the platform maintains its kind of quality as well. Constantly making sure that features are updated, the functionality is still good. It can still handle the load of having an increased number of clients, more usability, and obviously security on that side as well. And developing that, you know, enhancing the two-factor authentication that we've already started. And you know, as you can see on there, that we've done that by increasing our investment in the platform and obviously expanding our tech team as we expand as a company as well. So yeah, so just broadly to summarize, obviously we're really excited about releasing new products, new ways for people to invest, new products for them to invest in. But I think a big thing for us is to make sure that everything kind of on a day-to-day basis that people see and experience still maintains the same quality, and that's getting as much attention from us as well. So yeah, thank you very much for that. Just moving on then, we'll go back to some of the questions coming in. I don't know if you've seen anything particularly interesting, Richard, that you want to pick up on first. I haven't had the chance to have a look at it yet.
No, it's hang on, let's see here.
So I think there's always
I see questions being answered faster than I can read.
Well, there's always the one around ESG and SRI portfolios, and you know, how do we verify it? And greenwashing is a term that gets thrown around a lot, and I think that's quite an important one to answer. So how do we ensure that, you know, the investments that we invest in are always ethical and fit the bill of what we're looking to achieve?
So look, we should, you know, I think when we think about you know, when we sat down and thought about how we wanted to build an ESG proposition, you know, we you know, all the people that one of the things that we spent a lot of time was saying, well, how are we going to, you know, what's the potential for disappointing customers from an ESG perspective? Leave markets out of it for a second. And one way that you do that is that you somehow overpromise. And for us, you know, these ESG portfolios are a strong start, but they are a start of a journey, and that journey is centered around changing corporate practices. It's centered around much better use of data, and these things take time. So when we think about, you know, we're not picking individual securities, right? So when we think about what we wanted to show to customers and how we wanted to build this, we thought it was important to try and validate with data the sort of claims that we were making. And so what you see on our website are things around, you know, the difference in terms of CO2 emissions from a standard portfolio, a classic portfolio, to an ESG portfolio. And that's, you know, those are, you know, that's data that we think is robust, that you know, we think is going to improve over time. But you know, what we see is you know, significant improvements in terms of collecting data. We understand that, you know, that companies are spending more time in terms of generating that analysis, generating that data, and that it becomes an important part of the information that they share with investors, with the general public, with all of their stakeholders. And that's a critical step because, as Chris rightly points out, there's a danger that you think you're buying something that's very solid from an ESG perspective, and it proves not to be the case. So we think very much in terms of aggregates, and we want to see those aggregates built up or supported by data, and that's what we continue to focus on, and we think that will continue to be the case, and we'll continue to spend time thinking about that. The other part is that we spend a good amount of time on was around voting, and how ETF issuers engage with companies, because there's always a danger that a company does what it wants, and the shareholders have relatively less say in terms of how in terms of how ESG policies are set, and what we've seen is that it's a way for us to engage with the big ETF issuers, who are now large holders of for us of a lot of these companies. So that's something that we monitor on. It's an opportunity for us to engage with these big financial institutions, because the part of our ETF selection process is how those companies are voting, and we think that's something that's important. So to sort of summarize that, it's important to understand that this is the start of a journey. We continue to refine our offering. We continue to think about new ways of engaging with our customers, but also with the ETF issuers and with the providers. We think that having robust and accurate data is critical, and it's good to see a lot of investment going on in that space. But we're also keen to see new ETFs, using new data sources that we potentially can evaluate and invest in. And we hope that by thinking about aggregates and by thinking about measuring the difference between perhaps a classic portfolio and an ESG portfolio, we can quantify for our customers what that difference is, but also highlight where perhaps they are versus their own expectations. Because as I think everybody else is, we're very wary of over-promising in general, but certainly in the ESG space. And where we do make a statement, we very much hope to be able to have data to back that up. Chris, does that kind of
absolutely
no?
Yeah, I think so, very comprehensively. So thank you very much. Unfortunately, the time's actually run away from us slightly, but I think one more question, I would say. I saw it's come up quite a few times. There's never an investment event without someone asking about cryptocurrency, or several people asking about cryptocurrency. I see it's been answered a few times, but just a final word from the Chief Investment Officer on the matter.
So there's a good amount of interest in cryptocurrency as a Moneyfarm, as a financial technology company, you would imagine. Look, I think we continue to think about ways of the right way to get exposure to cryptocurrencies. Where does it make most sense? Is it in the currencies themselves? Is it in terms of blockchain investments? And there's a good amount of debate around that. I do think I would say that the core satellite thematic structure that Chris talked about is potentially a good way of doing that. Providing that exposure perhaps to people who are particularly interested in it. So I would watch that space. But we continue to be try to be thoughtful about what cryptocurrencies really are, what the how the use cases will develop, and importantly how to think about the right way to value them. What are they? Are they investment? Are they currency? Or all of these types of issues are things that we continue to discuss, and we continue to think about the right way to provide that exposure to customers, as we think it's appropriate.
Fantastic. Thank you very much, Richard. I think that's all that we've got time for this evening. I want to thank everybody for joining. If you could stay for a couple of seconds afterwards, we will have a survey on the screen. It will take a very short amount of time, but these things are very helpful for us to help develop these in future. I want to thank Richard. I want to thank Giovanni. And most of all, thank you all for joining and have a fantastic evening.